Okay, so today we're going to talk about the Treasury market, specifically the 10-year note futures. We're going to take a look at yields and a long-term chart and maybe put some perspective into some of the things that we're seeing on a short-term basis. Before we get started, I want to make sure you understand there's plenty of risk in trading futures and options. It's not suitable for everybody. We keep hearing, don't fight the Fed. That's the trendy tagline lately. And this is for good reason. The Federal Reserve unleashed a bazooka-style monetary policy to combat COVID-19 virus and its economic impact, which basically forced interest rates to nearly zero. But the Fed's also pledged to avoid a negative interest rate policy. Yet, for whatever reason, the masses have kind of finally accepted the fact that negative interest rates are a possibility. In fact, in my opinion, it seems like the masses have actually accepted that as something that's going to for sure happen. And I tend to think once everybody believes one thing, the market generally does the other. That's unfortunately how it works. We see that a lot. Usually when a story becomes mainstream, that's when it's run its course and the market surprises everybody and does the opposite thing. But let's just take a look at what we're dealing with here in the 10-year note. Yields are well below 1%. In fact, they're closer to 0.5% than they are 1%, which is pretty interesting. If you think about it, the S&P yields about 2%, and I realize that there's a lot of people perceive the stock market as being extremely risky, and obviously that's true. We were reminded of that. We didn't learn it, but we were definitely reminded in March and April that stocks can go down as well as go up. The interesting thing about the Treasury note is people think of Treasuries as a safe haven, as a place that they can put their money and they don't have to worry about risk. That's not necessarily true. In the 10-year note, if you buy a note today and you hold it for 10 years, you're correct. You're going to get your yield, and I mean, unless something really weird happens and the government defaults, but let's just assume that's not the case or not a possibility. So generally speaking, if you hold for 10 years, there really is no risk. You get what you expect. However, not everybody is looking to put money into an investment for 10 years that yields roughly 0.5%. That's my opinion, obviously. But what people need to realize is when treasuries are this expensive, when they're overpriced, there's massive duration risk and there is massive price risk. If the price of the 10-year note collapses, meaning interest rates go up, that 0.5% in yield that an investor is receiving is going to be minimal compared to the risks that they're facing. So when treasuries are expensive, they are extremely risky, in my opinion, maybe even riskier than stocks in some ways. So my thought is, if you can only get 0.5% or 0.6%, whatever you want to say, on the 10-year note, and you can get 2% holding stocks, of course, stocks it's going to be a rougher ride, probably, or maybe not, as we just discussed. But in any case, I think eventually, if the stock market behaves itself, I think eventually investors will realize maybe it's worth putting money to work in the stock market at possibly a 2% yield plus appreciation, as opposed to going into the Treasury market on the long end of the curve anyways, for very low yield and quite a bit of duration risk. Also, the upside in treasuries, as far as appreciation goes, is probably extremely limited, but the downside is wide open. So in other words, there's plenty of risk to be long and wrong in treasuries. And that 0.5% yield isn't going to do much in regards to cushioning your downside risk. So with that said, let's take a look at a 10-year note futures chart. This is a monthly chart. This dates back to about 2000. And we can see that the 10-year note really has only been this overbought 3 other times in history. And on both of those occasions, we saw multi-year sell-offs. Now, I think there's a lot of arguments that could be made that this time is different, and there's definitely some differences today than we saw in 2011 and 12, 2008, 2009, and then in the early 2000s. So I agree there's definitely some different things going on. But the weird thing is about charts is sometimes those don't matter as much as we think they do in the short run. In the long run, they don't. For example, In 2008, we could have obviously said this time is different. Things are different because they were. Same as in 2011, we were dealing with the U.S. Credit rating was being downgraded by Moody's. Same situation. So those times were different too. But guess what? The result was actually pretty normal. And that is the 10-year note held resistance. I mean, the 10-year note and treasuries in general are messy, so you can never expect things to be smooth sailing. But all in all, you can see that we've generally held resistance areas. And when the RSI gets above 70, the market tends to find some sort of a top. Now, that doesn't mean we're going to turn around tomorrow, but in the next several weeks or maybe a month or two, I think it's fair to say there's a pretty decent chance that the highs will be in treasuries. Hopefully not much higher than where we are here, but we'll have to wait and see. So if you're interested in playing in the treasury market or any commodities, we are a futures and options broker. We're DeCarly Trading. You can find us at decarlytrading.com. If you're looking to do some homework on how to analyze the futures markets, seasonality, fundamentals, those sorts of things, even technical analysis, higher probability commodity trading is available at any major bookstore. So once again, we're DeCarly Trading. We'd love to hear from you if you're interested in getting involved in the markets.